Thank you, Ines, and thank you for inviting me to speak at the Climate Alliance conference today. I'm sorry I can't be there in person, but at least this is a more carbon-efficient way to communicate. And I know that with aims to reduce emissions by just under 30% by 2030 and doubling renewable energy capacity by 2020, Australia's transition towards a lower carbon economy will bring both risks and opportunities for Australian businesses and investors. More broadly, changes in climate policies, new technologies, and growing physical risks are going to prompt reassessments of the values of virtually every financial asset worldwide. Firms that align their business models to the transition to a net zero world will be rewarded handsomely. Those that fail to adapt will cease to exist. And the longer that meaningful adjustment is delayed, the greater the disruption will be. So to bring climate risks and resilience into the heart of financial decision-making, climate disclosure must become comprehensive, climate risk management must be transformed, and investing for a 2-degree world must go mainstream. And that's what I'd like to talk about today, is how this can be done. I'm going to focus on the 3 R's, reporting, risk management, and return, and how they can maximize the risks, maximize the opportunities and minimize the risks in this transition. So let me start first with reporting. 2.5 years ago, in response to a call from G20 leaders, the private sector-led TCFD delivered its recommendations to ensure that the market had the right information to price climate risk and to reward climate innovation. And since that time, there's been a step change in both the demand and the supply of climate risk reporting. The demand for TCFD disclosure is now enormous. Current supporters control balance sheets totaling $120 trillion and include the world's top banks, asset managers, pension funds, insurers, the credit rating agencies, the Big Four accounting firms, and the 2 major shareholder advisory services. And of course, the supply of disclosure is now responding. 4/5 of the top 1,100 global companies now disclose climate-related financial risks in line with some of the TCFD recommendations. On every recommended metric in the TCFD, disclosures have been steadily increasing. And 3/4 of major investors surveyed are now using TCFD disclosures when making investment decisions. The momentum behind the TCFD's voluntary disclosures is starting to create a virtuous circle. As companies are applying the recommendations, investors are increasingly able to differentiate between firms based on this information, adoption spreading, and disclosure is becoming more decision useful and efficient. Better TCFD disclosure is also an opportunity, and the research by the Bank of England and PwC finds there's a positive correlation between companies' stock prices and the number of TCFD disclosures that firms are making. In other words, investors are rewarding companies that are leaders in managing climate-related risks. And that's just one reason why jurisdictions like the UK and the EU have now signaled their intentions to make the TCFD disclosures mandatory in the near future. In Australia, ASIC has already issued 2 regulatory guidelines which formally include climate change as a risk that issuers should consider disclosing. In my view, over the next couple of years, the current process of disclosure by the users of capital, reaction and input by the suppliers of capital, and adjustment of these standards will be critical to ensure that the TCFD standards are as comparable, efficient, and decision useful as possible. And through multi-sector TCFD summits and more focused TCFD industry preparer forums from oil and gas to agriculture, companies could continue and should continue to share knowledge on how, what, and where they disclose information in order to give financial markets the information that they need. Let me turn to the second issue, which is risk management. Climate change creates both physical and transition risks, as you know, physical risks that arise from the increased frequency and severity of climate and weather-related events that damage property and disrupt trade, and transition risks that result from the very adjustment towards a net zero carbon economy. For the market to understand where the risks and opportunities lie, the disclosures about these risks need to go beyond the static to the strategic. The nature of climate risks, given their breadth, their magnitude, and foreseeable nature, means the biggest challenge will be to assess the resilience of companies' strategies to transition risks. And the Bank of England has become increasingly active in such assessments, consistent with our prudential and macroprudential mandates. We're the supervisor of the world's fourth largest insurance industry, and as a consequence, we know that general insurers and reinsurers are on the front line of managing the physical risks from climate change. Those insurers have responded by developing their forecasting capabilities, improving their exposure risk management, and by adapting coverage and pricing. And in this process, insurers have learned that yesterday's tail risks are much closer to today's central scenarios. A recent survey that we conducted of over $11 trillion of banking assets finds that almost 3/4 of those banks active in the UK are starting to treat the risks from climate change like other financial risks, rather than simply viewing them as a corporate social responsibility issue. These banks have begun considering the most immediate physical risks to their business models, from the exposure of mortgage books to flood risks or fire risks, to the impact of extreme weather events on sovereign risk. And they've begun to start to assess exposures to transition risks in anticipation of climate policy action. This includes exposures to carbon-intensive sectors, to consumer loans, for example, secured on diesel vehicles, and to buy-to-let lending given new energy efficiency requirements in the UK. The Bank of England's recently published our supervisory expectations for the governance, risk management, and strategic resilience, and the disclosure, again, of climate-related financial risks. And this month, we start to become the first regulator to stress test our financial system against different climate pathways, including the catastrophic business-as-usual scenario and the ideal, but still challenging, transition of this economy to net zero by 2050. In response, the major UK banks will need to establish how their borrowers are managing current and future climate-related risks and opportunities. And we expect that those assessments will reveal which borrowers have strategies for the transition to a net zero economy, which are gambling on new technologies or government inaction, and which haven't yet thought through the risks and opportunities. This stress test will help develop and mainstream cutting-edge risk management techniques, and it will make the heart of the global financial system more responsive to changes in the climate and changes to government climate policies. Now, thirdly, let me turn to return. The IEA estimates that the low-carbon transition could require $3.5 trillion in energy investments every year for decades. In other words, twice the rate as present. Now, to finance this will require mobilizing mainstream capital. Advances in reporting and risk analysis are paving the way for investors to realize opportunities in climate-friendly investment by reorienting their focus to broader, more sustainable long-term value creation. But for sustainable investment to truly go mainstream, it needs to do more than just exclude incorrigibly brown industries and finance only deep green technologies. As Andrew Mackenzie, the CEO of BHP, said in a recent speech, the transition to new energy sources is necessary. That transition must be smooth, and it must take the whole economy with it. So sustainable investment, therefore, must catalyze and support all companies that are working in the transition from brown to green. And common taxonomies to identify environmental outperformance, such as the EU's green taxonomy and the Green Bond Standard, can help. But they tend to be binary. In other words, they're either dark green or all brown. Mainstreaming sustainable investment requires a richer taxonomy, 50 shades of green. One promising option is the development of transition indices composed of corporations in high carbon sectors that have adopted low carbon strategies. And we think consideration should also be given to the degree warming assessments that are now being undertaken by leading asset owners. For example, GPIF of Japan, the world's largest pension fund, calculates that its portfolio is aligned to a 3.5-degree world. Allianz, the major German insurer, assesses that it is on a 3.7-degree path and is committed to get to 1.5 degrees by 2050. AXA out of France estimates that its assets are currently consistent, again, with a 3.7-degree path, and it's also developed an innovative climate value at risk model to measure the opportunities as well as the risks from the climate-related exposures of its investments. We think these approaches could be taken more broadly. To conclude, financial policymakers will not drive the transition to a low-carbon economy. It's for governments to establish the climate policy frameworks, and then if they do, the private sector will make the necessary investments. But it can be most effective with a market in a transition to a 2-degree world, and that market is being built. It will reveal how the valuations of companies could change over time as climate policies adapt and carbon intensity declines. It will expose the likely future cost of doing business, of paying for emissions, and of tighter regulation. And it will help smooth price adjustments as opinions change, rather than concentrating them in a climate Minsky moment. That market in a 2-degree world will allow feedback between the market and policymaking, with policymakers learning from markets' reactions and the markets internalizing policymakers' objectives, strategies, and instruments. So as countries build their climate policy track records and their credibility grows, the financial markets will allocate capital to deliver the necessary innovation and growth and to pull forward the adjustment to a low-carbon future. In this world, companies from all sectors will need to make climate reporting more prolific, banks will need to make risk assessments more robust, and investors will need to optimize returns in order to facilitate that transition to a net zero economy. I trust, therefore, that you'll come away today with ideas of how you can help make this a reality. Thank you very much for inviting me. Best of luck with the discussions.